Welcome to 3 Minute Tech. These are the videos where we answer your technical financial planning questions without all of that jargon. Shot on location at our beautiful new offices, Level 37 QV1. Today we'll be talking about the now infamous Stage 3 tax cuts. Now, regardless of your political allegiances, it's something that you need to know, and how much tax you'll be saving from next financial year. So what are the Stage 3 tax cuts? Now, before we get into that, it's important to understand that this was part of a tax reform package brought forward all the way back in 2018. Stage 1 introduced what's called the low and middle income tax offset. Stage 2 simplified and extended some of the brackets and extended the low income tax offset, and now Stage 3 is ready to begin on the 1st of July 2024. So the Stage 3 tax cuts were legislated to introduce on the 1st of July 2024, and as you can see on the screen now, there are significant changes from the current rates. As it stands, the first $18,200 is tax-free. Between $18,245, it's 19%, going all the way up to above $180 when it's 45. Under the legislated changes, the tax tiers considerably reduce. There's no longer a 37% tax tier, and the 30% tax bracket extends from $45,000 all the way up to $200. But as I said before, these have changed. And this is why I've been reticent to do a Stage 3 tax cut episode. I've been asked, but we always expected there were some changes to come, and we'll be talking about them next. So very recently, the Labor government has introduced changes to these Stage 3 amendments. What's being described as giving back to more middle Australia. So they've introduced the 37% tax tier again, as shown on screen. They're reducing the top marginal threshold. Instead of applying from $200,000, it now applies from $190,000. And there's changes to the tax rate between $18,200 and $45,000. Now the question remains, with these proposed amendments, will they get legislated? And the answer is yes. The Coalition has recently said they won't be opposing the amendments in the lower house. So the expectation is these will be legislated as we approach Easter. So that's a lot of figures that I've thrown at you today. But what does it mean to you? How much tax saving will you be getting versus how much tax saving would you have got under the initial amendments? Well, as you can see on the table on the screen, it depends on how much income you're earning next financial year. For example, if you're earning $70,000, under the existing legislated rules, you would have got a tax saving of $625. That's being increased up to $1,429, so an $804 increase. For someone earning $110,000, under the existing legislated amendments, you would have been receiving a $1,625 tax saving. That's again being increased, this time up to $2,429, so another $800 increase. But for those who earn $150,000 and above, your tax saving is actually reduced. For example, someone on $190,000 was expecting a tax saving next financial year of $7,575. That's being decreased down to $4,529, so a reduction of just over $3,000. So this is important to understand where you sit on this table and equally what benefit or reduction you actually receive. So the question might be, are there any strategic considerations with this proposed change? And the answer is yes. It might be beneficial where your tax is actually going down next year if you can bring forward some tax deductions for this financial year, so get a bigger bang for your buck. And equally, in the future, when you're going to be getting a tax saving, what do you do with this capital? Do you put it towards your mortgage? Do you put it towards your investments? Or do you put it towards superannuation? And that's why advice is really important. So in today's case study, we have Peter. Peter earns $200,000 as a consultant. He understands that from next financial year, under the proposed amendments to the Stage 3 tax cuts, he'll get a tax saving of $4,500. So what does he do with this tax saving? He elects to put it into superannuation. His mortgage is under control and he wants to make more tax-deductible contributions to super like we've discussed in previous episodes. Now he's 40 years old and he elects to do this for the remainder of his working life. What does that mean for his retirement? Well, by the time he retires at age 65, he has an additional $240,000, all from simply redirecting his tax saving that the government's going to give him next financial year. So what have we learnt today? Well, we know the tax amendments are changing. Whether it benefits you or not will be dependent on your income. Now the rough rule of thumb is if you earn below $150,000, then yes, the proposed amendments will mean more money in your back pocket. But for those above $150,000, your tax saving is unfortunately going to be reduced.